Welcome to the Daily Update. This is being prepared Monday, July 18th, where we'll look at the action in the market today and then see how things look for Tuesday, July 19th. And this is a little bit pared down. I took out some of the slides because I feel like I'm just saying the same things over and over and over again. Not a lot is being settled right now, but I'm still looking at a lot of these, even with our possible positive scenarios. I look at those charts all the time. And if something changes, I will be quick to report on that in the video. So let's go back and talk a little bit about things. But first of all, remember that I do have a temporary email address. It's spxinvesting@gmail.com. I have no idea how long this is going to last. And it might be quite a while, for another month or two at least. So we'll just have to see how things go with that. And there will be no video on Wednesday, July 20th. So after I record this video for Tuesday, there won't be a video for Wednesday. My hope is to resume the video for Thursday's session. All right, let's go back and talk about what happened. At the open, we gapped higher. It looked like everything was going in the right direction. We had some momentum from Friday that the markets might dig in and use to justify going higher. And it looked like, okay, that might be what's happening. We opened to R2 at 38.94, which unfortunately that ended up being the high for the day. We set it right after the open because then we fell back. Now, after drifting sideways, and it looked like, okay, we're just going to drift sideways a little bit. That's similar to what happened on Friday, kind of the old smokestack look. But then prices began to fall. We fell down to R1 at 38.79. Then we went to the unchanged level. So we pretty much gave up all the gains that we had and then eventually went negative. After that, we fell below the daily pivot at 38.48 and we even dropped below S1 at 38.32. So it turned into a negative day. Prices ended up closing right near the low and just below S1, which again was at 38.32. We closed below that. We were down 0.84% on the day. Volume is still below average. The technicals, we kind of have to take more of a negative slant now. There are still some pockets of improvement. There are still some things that look positive, but when we see a real higher open like we saw, only to see things fall apart and end just about at the close, we kind of have to go with that until proven otherwise. The big thing continues to be inflation and interest rates, which are producing growth concerns. We have a whole list of geopolitical concerns. Earnings are starting to come out now, so that could have a real influence on the market. And then recession fears. Are we going to go into a recession? Are we in a recession right now? What's going to happen in the future? Okay, and we're still kind of at that point. That really hasn't changed much yet. So the sector rotation, even with the down day, it's still holding up. Didn't really gain much, but we were pretty much sideways. And I'll show you the charts on that. The 10 to the 2 and the 10 to the 5. And I'm not going to show you those charts today. Those yield curves, they still remain inverted. And why I have the different size type is kind of a mystery here. But that is also suggesting that we might be going into a recession in the future. Fear is decreasing slightly. Even though we had a down day, we actually bumped up a little bit with the fear and greed index. And then the hiking fears. Are they going to raise 1%? Are they going to raise 0.75%? Blah, 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 blah. All right. The report that came out, and this is the account that I read through after the market closed. They're saying, yes, after this report came out, that's when selling really picked up. I don't know if I would buy into that too much. This isn't really all that influential of a report. It came in a lot lower than expected at 55. It had been at 67 in the previous report, but I don't know. I think the market just wanted to go down. We started to decline and it just gained momentum. And eventually the momentum just kept going to the downside. That's where I come out. Now, some of you may not agree with that. The financial media, and that includes maybe emails that you receive or different things that you might read, They always want to make things black and white. They always want to have it cause and effect. This happened, and so the market went down. This happened, and the market went up. It's not always that simple. There are things that tend to happen around the same time. And yeah, it might have a bit of an influence, but the market's going to do what it wants to do, even when it doesn't make any logical sense to us. So that's why we have to follow what the charts are telling us, not necessarily what our logic is telling us all the time. And that's kind of where I come out on that. Our trend is, it's a negative trend, but we're dropping below ADX now. So we're more towards the neutral side of things, with our bias being negative. And I've kept our momentum at mixed for right now. We're just not really doing much these days. We go up, then we go down. Okay. So sentiment actually bumped up a little bit. It was at 27. Now we are at 30. And here's the historical chart. But again, we're down around this level. We didn't really see any capitulation. There wasn't any freak out. So can we really get some kind of a bounce out of this? It doesn't really seem likely. It hasn't worked yet because we've been down in this area for a long time. All right, here's some Isabel net charts. And one thing I want to mention is with the Isabel net, that's something relatively new. I used to look at those charts every day, but I used to not include them in the videos. If you think they're useful or not, please let me know what you think of that. I go through them kind of quickly because my attitude is, number one, do they apply to what we're trying to talk about here? And secondly, if I can't look at a chart and figure it out in about 8 seconds, I go on to the next one. I just skip it. If it's got a whole list of numbers or something, it's like, okay, is this really telling us anything? And a lot of them don't really tell us anything. And I just like it from a different perspective, just to kind of look at things, because these folks are professionals that put this stuff out, but we ultimately have to come to our own conclusions when we're looking at things and trying to make decisions. But last week we had the small business optimism index that came out, and it was pretty low, lower than what they've seen in quite a while. And over here on the right, it shows this is where we are. That's for June, because it's 1 month lagging with that folks are just not very optimistic right now that own small businesses. Duh, gee, you think? But when you compare it to other times, okay, it's saying that it's on par or about the same as 2020, where that was the shutdown, 2001, where things really were bad in the US, not only economically, but we had just been attacked by terrorists. 1991, that was also not a very good time for the US economy. So we're kind of pairing up with things that have happened at other times when we did have a recession, even though we're not in a recession officially, at least yet. All right, this one says, it's put out by Bank of America. And if we continue to fall, if we go down to 3,600, you can nibble at the market. At 3,300, go ahead and bite. At 3,000, go ahead and gorge. Well, these things to me are almost useless, because I don't know how many times when I used to watch the financial media like CNBC and Fox Business and Bloomberg, when somebody would come on and said, oh yeah, okay, we're going up really good right now, and we'll probably go down and retest the lows and all that. Well, that's all well and good, but it's pretty much useless, because the environment when things are going up is one way. And then when we go down to retest that lows, everything is shifted at that point. And the positive attitude that you might have when the market's going up, suddenly people are starting to freak out and everybody's looking at everything differently. And so it's not a complete comparison. It's not apples to apples when you're looking at upward movements and downward movements. I've seen that over again, where somebody will just blanketly say, we're going to do this, we're going to do that. And then it happens. And then they're all freaked out saying, well, gee, I don't know what to do here. Anyway, what they're saying in this chart is this is where we're at right now. We're at about a PE multiple, and that's looking forward. Because if you watch the weekly video, that's where I look backward with the trailing 12 months. We're at about the 37.76 level. That's where we're fairly valued right now with a PE of 16. Well, if we continue to drop the PE ratio, that means the market's going to get cheaper. We're going to go up and up and up. But as we do that, that means the S&P is going to actually go down. So they're just saying if the market continues to fall, that might be a better place to buy. If it falls even more, it's a better place to buy. I don't like doing things that way. What happens if we get down to 3,000? Let's say that happens. And then we're hit with a terrorist attack, or something happens to our president, or something, because that's when 9/11 happened. It wasn't in a vacuum. The market was already tanking at that point, and then we got hit by something. Bad things tend to happen when the market's in a downtrend. Good things tend to happen when the market's in an uptrend. Just look at COVID. We were in a solid uptrend. That's how we got the V-shaped bounce right out of that. We resumed the trend that we were in before that event happened. And I've seen that over and over and over. Well, when you're in a downtrend and bad things tend to happen, and we just keep going in that downtrend after that. Anyway, I don't know why I'm saying this, but it just came to mind. That's why I look at charts instead of trying to figure all this stuff out and come to a conclusion that way. Just look at what the price is doing on the charts. That's where I come out. All right. Here's the aggregated US equity futures positions. Shows that they're really falling off. These are asset managers and different leveraged funds, like the Ridex funds or the juiced ETFs that you use. They're really falling off right now because people are just not really optimistic about things currently. This is another kind of crazy chart where we have ISM manufacturing, and that's really important. That's why I like to look at these charts, even if it doesn't make a lot of sense. Let's see if we can make some sense out of this. That's the blue line, and the ISM has been coming down, okay, because we've been having a weaker economy. This dashed red line, this is a combination of the dollar, the price of oil, interest rates. It's standardized and then advanced by 9 months. It's like, okay, hocus pocus, abracadabra. Let's make a chart that is useless, but we might be able to get something out of. Again, I'm not into the shifting forward, shifting back. There are some very smart people that do this, and there are some newsletters that I subscribe to where they do this, and they're big believers in this. There's videos on YouTube where I watch people do this. I think it's interesting, but I have to admit, I don't necessarily buy into it that much, other than just from an observational standpoint. I don't use it to make decisions because history does not necessarily repeat itself. It rhymes. It's not always exactly the same. It's just a little bit different for people to say, this time is different. Well, we're seeing that now with cryptos. We're seeing that with all the different manias that have come on for hundreds of years now. Now it's just digital in the form of cryptocurrency, but nothing new is under the sun. It just changes how it looks a little bit, enough for people to think that this is different this time, only to realize in the end, it's not any different. All right, why am I doing this today? This just shows that we're very overvalued. The deviation from earnings when we're above and we're in the everything bubble right now, it just shows that we're very expensive. When we're below it, that's the long-term growth trend. But you can look back where in the late 90s, we had the tech bubble, then the real estate bubble, then the liquidity bubble. Right now, we're having the everything bubble, and it just shows that we are expensive right now when looking at this chart. Here's the sentiment indicator. We're starting to drop a little bit. We're down to minus 1.5. We're starting to get extreme, but we could still go lower than that. That's the dark line right here. People are just not very happy about things right now, and that's understandable. All right. This is showing bank loan flows. Are banks loaning out money? No, they're actually pulling in the reins right now. This dark line is the 4-week moving average of bank loans. And it shows they're really tightening things. That could really have an influence on the economy, since they can't loan out money for people to do things that generally benefit the economy. All right, let's look at the VIX. where we declined, or excuse me, we actually advanced a little bit and not very much on a down day, both with the line chart and with the bar chart. We closed kind of near the middle of the bar chart. The VIX of the VIX is showing a little bit of a pickup in volatility on both charts. The Ulcer Index is still very, very low. Again, the weekly chart seems to be a little bit more realistic. We're down 20.5% from the all-time high. Equity put call ratio actually declined on the 1-day chart, and on the 5-day chart, it's actually coming down. And that's one of the ones I'm not going to show for a little while, is the longer term 5-moving average with the spike. I'm going to give those a rest until they start really telling us something. Now, this is interesting because we have a Fed meeting coming up on the 27th. This is what we were looking at on Friday, July 8th, a 92% chance, over a 92% chance, that we'll have a 75-point rate hike, 0.75%. All right, that's what it was on the 8th. Then we jumped to Thursday, the 14th, after we had some strong economic reports. It jumped back to close to 50-50. This is what it was on Friday, and also after Monday's session, we're back up to 69% chance that there's going to be a 0.75% rate. Apparently, there was some article in the Wall Street Journal. I get the Wall Street Journal, but I tried to look for this, but apparently didn't look hard enough, that kind of put a lot of the market at ease, saying that it's not really looking like we're going to get a full percentage point increase, but it might happen. And there's still some time between now and the meeting, but that's why we're watching this pretty closely. But apparently that article helped settle things down a little bit. And they're attributing a lot of the bounce on Friday to that. Well, didn't really carry through to Monday's session. I've taken out a lot of the support and resistance charts too. Some of them just drive me nuts, and I just can't see how they're really helping folks. Here's the daily pivot points for Wednesday's session. So there, I did do something for Wednesday after all. Excuse me, this should be for Tuesday's session. My goodness, I'm screwing things up. This chart I have used quite a bit. We can see at the bottom where we're below average. We fell back below this pivot level right now, and that's kind of negative. We were right at it, and it looked like we may be breaking above it. Nope, at least yet, that's not happening. Here is the pivot points, the different ways to calculate them for the month of July. Right over here, the Fibonacci levels, we're still kind of dancing around this 61.8 and 38.2% retracement level. The different sectors, we had a down day, so healthcare and utilities were down over 1%, with healthcare being down over 2%. We had 3 sectors that were up: materials, discretionary, and energy. Here's the scooter scores showing that energy is still in the lead, followed by utilities and healthcare. Those that are the weakest, or at least this is into the low 20s here, with materials, and communication is at 10.5 right now. Here's the same chart that we've been seeing, although utilities have switched slightly negative now, with energy still being up. All the other sectors are down since the all-time high. Here are the indexes from the all-time high. Really nothing has changed. Some just kind of jockey around a little bit, but everything is negative since that point. Our technical alerts, some positive that happened right when we opened. And let's see, we had some sectors that had a BPI that looked positive. And then the S&P got above 3,900. Apparently that served as some kind of, okay, I have to really clear my throat now. That served as some kind of overhead resistance. And then as the day went on, we turned a little bit more negative. Here's the chart showing how that we spiked up, got up to R2. This is when we set the high for the day. We just kind of camped out here, and it looked like, okay, maybe it's going to be like what we saw on Friday. We just camp out and then maybe eke a little bit higher. Well, we just kept going sideways. Then eventually we started to fall. We came down to the unchanged level. That's the dash line. Came down to the daily pivot. That tried to hold things up for a little while. First as support, then as resistance, and then we ended up continuing to fall down below S1. All right, our trend, we have the ADX ever so slightly below 20 right now at 18.98. So we're more or less in a sideways market. The Arun is showing a little bit of an improvement with the selling pressure decreasing and the buying power flat. So overall, it's picking up that things are slightly better. Breadth, after seeing a really good breadth day on Friday, well, we saw some more weakness based on price on Monday, and then we're pretty much flat. If anything, the volume is holding up a little bit better right now than the price, and I'll show you that as I go through this. Advanced decline ratio, slightly negative. New highs, new lows, trying to turn back up, but we're going to lose this if we don't get some follow through. Accumulation distribution, also still above the moving average, even though it did decline. Some short-term charts, we're down at the bottom now with the 20-period simple moving average. Right now, Stochc RSI, after being extreme positive, is starting to fall a bit. Williams percent R is also looking a little bit more negative. The force index just right about at the unchanged line. This is encouraging. The Swinland trading oscillator advancing based on price and volume. McClellan oscillator slightly negative. The moving averages declining up to 20, 50, and 200. Stochastic turning down with the short term, still going higher a bit with the intermediate term, and floundering to lower with the longer term. Our PMO still is positive. We're negative based on price, but see how that's ticked up slightly? We're a little bit positive based on volume. And the PMOs that are rising decreased. The PMOs that are giving buy signals were pretty much flat, and we're pretty much flat with those PMOs above zero. Chaikin oscillator, it picked up the decline that we had, so it's rolled over a bit. Chaikin money flow still showing some improvement since we closed, I guess, kind of near the high, but it's hanging in there. The volume measurement that we use does show some improvement, but we're still negative overall. The vortex is still negative. The summation based on price is negative, but look at summation based on volume. It's still positive. We're seeing a bit of a mixed picture with our oscillators. The slope is now negative, where the MACD, KST, TRIX, and PMO are positive, and we're slightly positive to almost getting ready to roll over with the TSI. The BPI, it actually put in kind of a nice little bump. And then when we started to tank after that, apparently no new triggers were signaled at that point. Ease of movement is showing a decline. The ultimate oscillator is declining. TTM squeeze, it's turning to a darker color now, which that's a little bit more negative. Kind of goes counterintuitive to what you would think. So this is a little bit more negative. I only have a couple of charts, different charts, where the Heikin Ashi is still looking okay, but the Kegi is still negative, where it turned red. Here's the point and figure. We had a couple of nice X's drawn in there, no new signal. It picked up that move that we had right at the open, and then nothing was calculated after that. The elder for the S&P has turned back to negative, and it's also negative for the SPY. The SAR continues to be negative. We're still in more of a lighter purple color for the go, no-go system, so that's slightly neutral to negative. We're seeing a decline with the 50, 150, and 200 period moving averages. Special K flattening out. It doesn't know what to do right now. The diamonds are still positive. So we have negative with the S&P, positive with the diamonds or the Dow. And we fell back below with the Dow below the pivot. Here's the Qs where they've switched back to neutral. So we have negative, neutral, and positive. Do you think the market's a little confused right now? And here's the NASDAQ 100. We're still above the pivot right now. Can it hold above this pivot level? That would be more positive. And we're looking at the NASDAQ and the NASDAQ 100 for leadership right now. We saw a bit of an advance on the Vixen, which is the VIX on the NASDAQ 100, based on a closing basis, but the bar pretty much matches what happened on Friday. Here's the NASDAQ, also still above the pivot level. Wilshire dropped below the pivot level. That's a little bit more negative. Wilshire is a broad-based measurement. The dollar actually declined, and that's what was giving the stock some support. And that's why I kept thinking as this was happening, we kept going lower and lower. I thought maybe they'll get some support from the declining dollar, but that just didn't happen. But the dollar is still in an overall uptrend. I've also put to rest right now some of these correlation charts, because it's like, okay, neutral, telling us nothing, tell us nothing. So I'm just kind of letting them rest until they do start to tell us something. Where we saw a real decline, where the dollar is starting to go in the opposite direction of stocks right now. Oil still below 100, but it did advance to 99.42. Oil is starting to go in the same direction as stocks. And there are times when that happened. A lot of the advances that we saw back in the teens, 2014, 2015, 2016, when the markets were going up, oil was going up at the same time. So there are times when we do see that. Looking at bonds, the tech sector to the 10-year correlation, they're going in the same direction right now, which is not necessarily what we would think we would be seeing. This is the 10 to the 3-month yield curve. It's not inverted yet, but we do want to keep an eye on this. If it drops down into this red area, that would, for a lot of economists out there that I respect, like Edward Yardeni, if we drop down here, then he will go into the recession camp now. He's at about 45, 50%, the last I heard from him. Here just shows our kind of crazy looking yields at all the different maturities, with the short-term maturities really advancing. Our scenarios, we're going to lose the Copic curve. If we drop down below this, then I'm going to take this chart out. But we're still generating a valid signal with the Pring bottom fissure. But my gosh, we signaled this quite a while ago, right at the beginning of July. And look at what the market's done. It hasn't really acted like much of a move was really going to happen. This is the one that we're really keeping an eye on. These are the Qs, growth. They were pretty much flat compared to the S&P. They were actually up a little bit, discretionary to the S&P, and growth to value was a little bit down. Here's some other growth to value measurements, pretty much flat with the large caps. And that's what I tend to watch the most, because the S&P are large caps, but we want to keep an eye on the mid caps, which were flat to slightly down, and the small caps too, because we want to look at the whole market altogether. But for focus on what I do in the program that I have, we pretty much focus on the large caps, which is the S&P. There's the staples. We are getting ready to see a death cross. It's less than a point away. The 50-period moving average is at 72.73. The 200-day moving average is at 73.33. So not less than a point, but getting close right here. And then the staples, we're coming down a little bit with our staples ratio. Is that going to be a valid spike? We certainly didn't see it with price follow through. All right, so what's our outlook then? For Tuesday, the technicals, they're negative. Yeah, there's some pockets of things. There's volume that we can look at, but we're just not seeing it really that much based on price. Sentiment, we're working off, being extreme fearful. We do have housing starts and building permits coming out this week, or excuse me, on Tuesday. And then the whole list. The only one that I really added here is Italy. And I took a lot of the words out of that. There's some political instability happening in Italy right now. Is that going to influence how the European central banks handle their interest rates and their inflation situation? So what are our scenarios? We're not really down right now because the ADX is below 20 for all the different reasons that I talk about. It seems like every stinking day. And it was really kind of hard to go up now. Now, we could always defy that. The market can do anything at any time, but based on what we're seeing in the charts, it's going to be really difficult for that. But our sector rotation is still holding up. Some of our positive setups, they're still on the table, even though I didn't show the charts today, and I might not show them for a while. I'm kind of trying to keep these videos a little bit shorter if I can, but the technicals are not really helping things for going up, and we are more sideways because the ADX is below 20 and negative. So we are negative overall on all the time frames right now with the S&P 500. So thank you. Have a wonderful Tuesday. I will not be able to prepare a video on Wednesday. So the next time I will talk to you will be before Thursday's session.